Well, this is our last chapter, last segment, Chapter 15, Part B. In this segment, we're going to follow the process of a firm issuing debt and repurchasing stock, a recapitalization. We're using the given data for Pizza Palace in the Chapter 15 mini case, as shown on the slide. Cost of equity using CAPM. Beta is 1, risk-free rate is 6, market risk premium 6, required return on equity 12%. Pizza Palace currently has no debt. Their cost of capital is the cost of equity, 12%, tax rate 25%. Using the free cash flow valuation model, expected free cash flow of $90 million, no expected growth, and a cost of capital of 12%, we arrive at a value of operations of $750 million. Currently, Pizza Palace has no debt, no preferred, and no short-term investments, and 10 million shares outstanding. Using the data given so far, we find a share price of $75. If Pizza Palace decides to issue debt, they'll use the proceeds to repurchase stock. This is called a recapitalization and makes a major change in the capital structure by increasing debt and reducing equity at the same time. The rates on the slide are those an investment banker has advised Pizza Palace they will face at various levels of debt. Amada's formula demonstrates the M&M theory that the beta of the equity of an unlevered firm changes with the level of debt. In this equation, beta sub U is the beta of the firm unlevered. Beta sub L is the levered beta. Recall the underlying theory on this. When a firm takes on more debt, the risk is focused on the equity holders. There's a video tutorial on unlevering and relevering beta posted with this unit that walks through the process. Applying Hamada's formula and using a 20% debt level, we find Pizza Palace's beta rises from 1 to 1.188. This leads to a new cost of levered equity of 13.13 versus the unlevered cost of 12. Using the 20% debt level, the new cost of levered equity and the cost of debt at a 20% level yields a cost of capital of 11.7. On the next slide, we'll see the results of repeating these calculations for all the debt levels Pizza Palace is considering. The optimal debt level for Pizza Palace is found where the weighted average cost of capital is minimized, which is at the 30% debt level. Continuing with our calculations and still using the 20% debt level, we can find the value of operations using the free cash flow method. The value of debt is 20% of that total value, and the remainder is equity. We repeat these calculations for all levels of debt being considered, and we'll see the results on the next slide. These further calculations continue to verify that the 30% debt is the optimal level for Pizza Palace. At 30% debt, the weighted average cost of capital is minimized, the value of operations is maximized, and the stock price is maximized. Still, we're going to move forward using a 20% debt level in our example. Pizza Palace was uneasy about jumping all the way to 30% debt, so the figures in red are what we expect to see as we move through the recap process. Now to the recapitalization. Here's the situation for Pizza Palace before issuing any debt. When the firm issues debt equal to 20%, the cost of capital decreases to 11.7. The value of operations increases to 769.23. The firm parks the proceeds of the debt issue in short-term investments equal to $153.85 million. Short-term investments and debt are now equal. Note that the stock price increases from 75 to 76.92. The wealth of shareholders due to ownership of equity increases from $750 million to $769.23. Repeating, the stock price increases from 75 to 76.92, and the wealth of shareholders increases. Recall, we've said it's the announcement of the repurchase that sends a signal to the market. If investors think the repurchase is going to increase the stock price, they're going to buy all they can, which will drive up the price. If they think it'll decrease it, they'll sell short. It's not the repurchase that affected the stock price. It's the issuance of debt. We need to find out how many shares we'll repurchase with the proceeds of the debt issue. Since we had no old debt and all the new debt will be used in the repurchase, these calculations are pretty straightforward. We'll use the full 153.85 to repurchase stock. Using the full amount of the debt divided by the current stock price, this will leave us with 8 million shares outstanding. And this is the final result of the recapitalization. Debt was issued and stock repurchased with the proceeds. Note that the stock price and total shareholder wealth remain at their elevated levels after the recapitalization. This slide recaps the key points from what we have seen in working through this recap. The firm parks the proceeds of the debt issue in short-term investments until it uses it to buy back stock. The stock price rises on the issuance of debt and remains at that level. Though the value of equity falls, the number of shares outstanding falls in sync, so the stock price stays constant. The wealth of shareholders also remains at the elevated level. Though 30% debt is the optimal capital structure, Pizza Palace elected to go with the 20%. There are some shortcuts available to speed up some of the calculations. To find the value of equity after the recap, simply multiply the before recap value of equity times 1 minus the percentage of debt. The number of shares outstanding after a repurchase can be found as shown on the slide. Finally, we can easily find the share price of the stock after the recap using the formula on this slide. While using the corporate valuation approach that we worked through will always give the correct answers, these shortcuts can speed up finding some of the numbers or serve as a check on calculations. The conclusion on Pizza Palace's planned recapitalization. 30% was the optimal level. Highest corporate value, lowest cost of money, highest stock price. Cost of debt at 40% is pretty close, so the optimal range is rather flat in the 30 to 40% range. If a firm's debt is risky, then management could decide to default on repaying it. If default is an option, then the decision of whether or not to repay the firm's debt looks very much like an option on the firm's equity. As much of a stretch as this might seem, Black & Scholes actually offered this use of option pricing in their original work in the 1970s. Suppose this firm has zero coupon debt with a face value of $2 million. Current total value of the firm is $4 million. The choices are: the firm pays off the $2 million in debt and the equity holders keep the firm. Or the firm defaults on the debt and the debt holders foreclose. Equity holders get nothing. Putting this into the Black-Scholes option pricing format, this is how the equity holder's position looks, portrayed as an option. P is $4 million, the total value of the firm. X, the exercise price, is $2 million, the face value of the debt, the exercise price, what the equity holders must pay to keep the firm. And T is the time to maturity of the debt, 1 year. If we assume a risk-free rate of 6% and a volatility of 0.60, then we'll see the calculations. Here's the formula to value a call option using the Black-Scholes option pricing model from Chapter 8. We've defined P, X, T, R, and volatility in terms of the firm's equity and debt. Substituting our values in the equation, we lay out the call formula and find the values for D1 and D2. Using Excel's norm SDIST function, we find ND1 and ND2. With those normal values, we can finish our calculations, finding the value of equity is $2.196 million. If the firm in total is worth $4 million and equity is worth $2.196, then the value of debt must be the difference, $1.804 million. Since the debt is zero coupon, we can determine the bond's yield to maturity using equation 1520. Yield to maturity on the firm's debt, 10.9. Remember from Chapter 8, with options, higher volatility means higher option value. Higher option value means a higher value of equity. With stock options, the riskiness of the underlying stock is already determined. Option valuation in a corporate application is different. Management can affect the firm's volatility by changing the risk of the projects the firm invests in. As the slide states, changing the risk changes the volatility, which can change the value of equity even if the expected cash flows generated do not change. Given a set value of the total firm, increasing the volatility increases the value of equity, which reduces the value of the remaining debt. This graph illustrates the effect of changing volatility on the values of debt and equity. Managers who understand this relationship might announce a plan to invest in one type of projects while actually investing in riskier ones. The downside: if bondholders realize what's happening, they'll either demand a higher coupon rate on the debt or simply refuse to buy it. Along with deciding how much debt a firm should have in its capital structure, the firm must also decide on the appropriate maturity for any new debt. One approach is called maturity matching, which means matching the maturity of debt to the maturity of projects financed by that debt. A second approach to managing debt and maturity involves information asymmetries. Suppose a firm has better future prospects than investors realize. If they issue long-term debt, they'll be paying a higher coupon rate for a long time, higher than they should. The solution is to issue short-term debt with a plan to refinance when the company's true future prospects are public. This ends Chapter 15, Unit G, and the lectures for this course.